Hello, everyone, and welcome to the Stanford Brown SB Talks podcast, where we explore various elements of your financial world. Today is Monday, August 9th, and we are again catching up with our Chief Investment Officer, Ashley Owen, to discuss investment markets, interest rates, government stimulus, and the outlook for the quarter ahead. Welcome, Ashley.
Welcome, Vinny, and welcome wherever in the world you are. Good morning, good night, good evening, wherever you are. Welcome.
Now, for the keen observers amongst you, you'll notice that Ashley and I are very much socially distanced here. Ashley carefully locked away in his home library as Sydney works its way through our latest Delta challenge. And before we get into the podcast update, I do want to speak very briefly to all our clients to, wish them all the best as we work our way through this. No doubt, many people will be dealing with a variety of different challenges, from some home more isolated, some juggling family and homeschooling commitments, and our thoughts are certainly with everyone as we work our way through this. Importantly, our Stanford Brown team remain working securely from their various locations across the city, and even though it's not business as usual right now, at least our business can continue to operate and serve, and albeit in a virtual capacity, and hopefully we're all together in person very soon. But we think of you all as we work our way through this. Now, Ashley, July, another quite positive month for shares. It sort of started off a little bit slower, but quickly picked up momentum as the month went on, and we saw the US reporting season click in, which has broadly been quite positive. The momentum continues.
Yeah, July was a pretty good month. Shares are up a percentage in Australia across the board, and pretty much around the world. Every country sort of drifted up. We've had pretty much, I think, 7 or 8 months in a row of good positive returns. We had a couple of wrinkles last year, late in the year, but only a percentage or two. So really, since the last 18 months, since sort of March last year, February, March last year, with the COVID crisis, which was a massive tank, markets down 35, 40, 45% around the world. It's almost a straight line up last year, and then flattened off during the months of this year, which is very similar to previous crises. You look at the GFC, it was straight down and then suddenly up during 2009, and then flattened off in 2010. Same sort of picture this time around again. So share markets around the world have pretty much regained, by earlier this year, they'd regained what they'd lost last year, and in Australia we're up 10-ish%, and US is up 15-ish%. So pretty much all markets now are above what they were last year. Which
we wake up most mornings to US markets breaking some new high watermark.
Yeah, sounds good when you say it quickly, but if you remember that the profits have sort of halved in that space, and they are only now just coming back, it means that shares were expensive before COVID. Shares were expensive across the world, and including Australia, and pretty much vastly expensive in America for a whole lot of reasons. And then they dropped by half, and then they're back to more than where they were last year, and yet profits have dropped. So that makes the markets on most measurements of value more than double as expensive what they were last year. So a lot
makes this, I would say, that makes this reporting season quite an interesting one, because now you probably have more sustained period of return to, I don't want to say normality, but new normal, to not use that terribly overused phrase.
Yeah, that's right. So profits are important, because share markets around the world are trading on price earnings ratios of 50 and 60 and 80, including Australia, which is just mind-bogglingly stupid. But that means that based on the profits reported over the previous year have been down, it's all based on profits regaining their previous highs. So that's why profit season in Australia, which we're now getting into, we've seen a couple of reports from the banks and from the big mining companies, Rio, massive dividends, and Fortescue next, and BHP. So the banks in Australia are starting to write back their overly cautious provisions last year. So banks are sitting on, in Australia, everyone was expecting a big recession, a normal recession, where you have unemployment at 15-20%, you have repossessions, and you have bankruptcies every day in the paper. That didn't occur because
they made provisions for that.
Government's bailed out everything. So all those provisions that bank made around the world, and including Australia, they're being now written back into profits, which is good. So banks in Australia are sitting on about $35 billion excess cash, which they won't need to provide for bad debts. So you'll find, and they're starting this week and last week, they're starting to actually announce increased dividends and buybacks, which is very unusual for banks. So that's good. globally around the world. So bank profits are up around the world because of two reasons. One is the bad debts they didn't have to write off in the COVID recession because of government stimulus. The other reason bank profits around the world are surging is because of the massive amount of investment banking activity. IPO activity has been through the roof, debt raising's been through the roof, equity raisings have been through the roof. So
we had an incredible example of that in the last couple of weeks, or last weekend, I should say, with Afterpay, one of Australia's largest ever corporate deals.
That's right. So Afterpay, which was a little startup in Australia 3 or 4 years ago, never made any money, never will make any money, but it captured the attention of
Square.
So Square buying that for about $40 billion, all script. There's no cash, all script. So you've got to sell your Square shares on the US market if you want to cash out and then pay tax on it. So that's an example of massive. When you've got, I mean, every kid at school gets taught how to discount cash flows to arrive at a value, and every analyst in the world has a calculator which discounts future values to arrive at a net present value of an asset. Every asset in the world can be valued on the basis of discounted future cash flows. The discount rate you use is very important in determining the asset value. So if you've got a cash flow of $10 a year for the next 10 years, you can discount that and you get a capital value of about $40 or $50, depending on how much you discount it by. The problem with the world now is you've got interest rates at zero around the world, including Australia. So your discount rate on your calculator is zero. That means any asset, even though it's worth nothing, any asset with a discount rate of zero becomes worth infinity, just mathematically.
So essentially, I guess the level of return that people are seeking for the risk that they're taking is dramatically gone through the floor.
Because exactly, so people are saying, well, I can't get any money out of TDs. TDs are paying 0 or 10, 15 basis points. So I need to put money into things that earn me more. So every asset in the world has been inflated in value because your discount rates for valuation are 0. It means complete fluff is now worth money. So you've got cryptos and NFTs and all sorts of things being floated and being bought and sold for ridiculous prices, because with a discount rate of 0, there is no value. Everything's worth infinity. Now, that's a problem that central banks have created deliberately in order to create speculation, in a hope that it leads to jobs and wages. It won't, never has, never will, but that's the theory behind this. So you have central banks around the world, when we're getting into the talk about inflation and when will cash rates rise, which is the big question for investors, central banks know, led by the Fed, they know they have to rein in this free money, because it's just creating asset bubbles, which is not good for anybody except you and I who have assets and investors who have assets. The vast bulk of the population, the workers, haven't received a pay rise for 30 years in Australia in real terms, in the US in real terms, in Europe it's backwards, in Japan it's backwards. So all this free money created by central banks is bad policy-wise. They know it, everyone knows it, so they have to start raising rates. So there's two forms of stimulus in the world which is supporting asset prices and share prices and property prices. One form of stimulus is the free money created by central banks in the form of 0 interest rates and asset buying,
quantitative easing,
asset buying, which is going on in every country, every major country.
We're probably 10, 11, 12 years into that now.
Well, in the case of Japan, we're 30 years into
true,
it. In the case of US, we're 12 years into it. In the case of Europe, we're 7 or 8 years. So the monetary stimulus, which is 0 interest rates and asset buying, which simply pumps up asset prices, that's one half, that's the monetary stimulus. And that is a debate we'll get into in a second about how and when that will be reined in.
And what inflationary impacts it's having.
Exactly. So the second sort of stimulus in the world, which is supporting incomes and wages and activity, is fiscal stimulus, which is government deficit spending.
So we've got our job keepers, our furloughing,
infrastructure packages. A lot of it's going on in Europe. A lot of it's going on in the US. Biden administration is sort of
package after package.
Package after package. So they've increased that, which is so the fiscal stimulus, which is creating activity, jobs, incomes, putting money into people's pockets, which they then spend. There's a debate about, obviously that can't go on forever because all you're doing is creating debts for your kids to pay off. So the fiscal stimulus is one debate. To what extent that should continue and when should that, if, should be wound back. And then you've got the monetary stimulus, which is central banks money printing and 0 interest rates. So the combined impact of those two stimulus programs has created inflation and in expectations of inflation everywhere. So in the US, inflation's running at 5%. In Australia, it's running at 3%. In Europe, it's even in positive in Europe and Japan. Couple of points about inflation. These headlines.
We get this debate between what is transient inflation and
exactly.
what is underlying.
If you can imagine a ditch in the road, same as share prices. Share prices have risen 35% in the last 12 months. It sounds good, but all they've done is recover what they lost last year. So all you're doing is you had a ditch, which is negative, a negative GDP of 15, 20%, 8% in Australia, negative inflation, negative prices, negative share prices. We're on the other side of that curve, so we're on the growth side. We're on the other side of the ditch. So of course you see inflation at 5% because inflation was negative last year. So if you forget about the point to point and just look at the curve over 2 or 3 years' time, you find that there's a bit of ditch. The other side of the ditch looks great. Inflation is 5%, GDP is growing at 4, 5, 6%, but all you're really doing is filling the hole left last year. So ignore those headline numbers and look through that to find out where their road's going. So inflation is running at headline rates of 3, 4, 5% around the world and including Australia. Sounds bad until you realize it's really just recovering the negative inflation last year. What's the road look like? The answer is the road still looks moderately sloping upwards, not scarily high, like the headline numbers will say, but certainly monetary stimulus and fiscal stimulus in particular has put money in people's pockets, and they've spent that on all sorts of things. So PCs, home and renovation, bathrooms, kitchens, building the home office, those sort of things has been very good. Some retail sales have collapsed, of course, because you can't go into physical stores, but by and large, retail spending has been strong, confidence has been strong, incomes have been strong, cash balances in people's bank accounts has never been higher in the history of the world. There's still $5 trillion of cash sitting in people's bank accounts from stimulus last year. They're still yet to spend. So that when they spend that, which they will, it will create more inflation. So getting back to your two things, you've got the fiscal stimulus, which is putting money in people's pockets and supporting jobs and businesses. That's real economy stuff. That's actually building roads. It's building bridges, building tunnels. It's actually doing stuff which employs people. So fundamentally, that's creating wealth and creating jobs for people. So that's good. The monetary stimulus, the free money and money printing, doesn't go anywhere except asset prices. That's why you get house prices up 20% in every country in the world, including Australia. All it does is push people on the lower income scale out of the housing market. So that's bad in every form, but everyone knows it's got to stop.
But so when?
In the US, this is a great debate. You've got fiscal stimulus, which can't continue because it creates debts that kids have got to pay off. So of those two, the fiscal pie and the monetary pie, probably everyone agrees that the fiscal side is doing a reasonably good job in creating real incomes and real jobs. The monetary side is pure fluff. It's just creating crypto bubbles and afterpay bubbles and what have you. So of the two, probably, and you look at the various members of the Fed over the last couple of weeks have done some talking, some out of school, some in school, to say that, look, the Fed's got to act. So we've got to reduce the monetary stimulus side. What that means in practical terms is cash rates will rise. Now,
well, don't we need to see the bond buying programs reeled back?
That's right. So what the Fed over the last month has done is, which is good. Remember there was a big inflation scare in February, March, when bond yields suddenly jumped up in Australia and around the world because everyone said, holy crap, they're going to raise rates soon. So bond yields jumped, which means bond prices fell, and bond markets around the world fell by 2 or 3%, which is a big deal for bond markets. Share prices kept going, they flattened. That's the point, the share prices flattened off after the rebound last year. So what's happened since then is, sensibly, Jay Powell at the Fed has said, look, yes, we will eventually need to raise rates, but here's a timetable. And the timetable says, before we even touch rates, we're going to have to slow down the QE asset buying. So remember back to May 2012, and again in May 2013, you had this taper tantrum.
Taper tantrum tongue twister.
And they suddenly said, oh, we're going to have to start raising rates or tapering out of QE, and that caused markets to sell off around the world in 2012, again in 2013. So every time they tried to do that, markets fell off the cliff. Now, they did eventually taper a QE buying back to zero by 2015, 16. Then
communicated and over-communicated around it very slowly.
That's right. But then they started to raise rates. So the problem with that is the Fed throughout history, it was always acted too late and therefore too heavy-handed. They've always come down too hard and too late. Why too hard? Because they've been too late. Only one exception, that was Greenspan in '94, and they don't want to do that again when he went preemptive. That's the last thing they want to do. So they know they're going to learn to try and flag their rate rises slowly and carefully. Now, given the post-1980 deregulation, small government, hands-off, globalization, low taxes, that world is gone. That disappeared in the GFC. We're now into a Keynesian world in the 1930s and 40s and 50s where governments own and run everything. So every time something goes wrong, governments will throw money at a problem to fix it. Just look at the COVID crisis last year and the lack of bad debts in banks. So the Fed is now probably going to be terrified. Jay Powell raised rates the Fed raised rates 9 times from 2015, December 2016 into 17 and into 18, and share markets, 4 rate rises in a row in 2018, share prices fell 25%. So they know that if they do that again, share prices will fall off a cliff again, and they'll have to bail out the shareholders again with free money. So they're terrified of doing that too early. So what I think they'll do is they'll wait far too long. Inflation, forget the 5%, but the real inflation, the real road going north, the real inflation will start to rise by 2 or 3 or 4%, which is real inflation. Wages will start to rise, house prices will keep rising.
And you're talking about inflation here in the US, obviously.
And Australia as well. Australia as well.
And I guess we should distinguish that from perhaps other parts of the world where the declining population might suppress it quite a bit.
Correct. So I'm pretty happy that Japan and Europe are dead. So mind you, that's still a third of the world economically. So it's important to take care of, to understand. So the bond market, for example, a third of that's in Europe and a third of that's in Japan, and only a third of it's in America. So the bond market's driven by two-thirds of the world, which is dead and dying and stagnant, and moribund, which is Europe and Japan. Only a third of it's really US. So that's why the bond market's actually got a bit of strength in it, because Europe will be dead for years or forever, and Japan as well.
The risk of inflation there is significantly
less. Risk of inflation is very
low.
low. Real inflation is very low. Plus you've got immigration and keeping down wages, etc. So the Fed will act too slow and too late. So probably there's, as I've always said, there's going to be lots of temporary bond inflation scares from time to time. We saw one in February, March this year. Bond yields jumped up by about 1%, and they fell back very, very sharply this year. So bond yields have come back to a bit above 1% in Australia and the US and even Canada. So that's actually, and they're even deeper negative in Europe, and they're negative now in Japan again, even though they're trying to pop it up to 0. So I suspect that the Fed and other central banks around the world, pretty much every central bank around the world, including Australia-ish, Canada, New Zealand, UK, Europe, and the Fed have all said we need to start thinking about talking about a timetable. So the Fed had a famous meeting last month, which was the meeting where they talked about raising rates. So we know they're thinking about it. The former head of the New York Bank was on last night saying we're gonna go early. We're gonna have to go early, and he's not in power. He was a former head, but he's saying we will need to start really doing something now. So share prices have been drifting up because profits have been, the profit hole of last year has been filled up. In Australia, it's been by the banks and been by the iron ore exporters, which are phenomenally wealthy in terms of their banks are now, for a long time, miners were the biggest companies in Australia, CRA, which is now Rio, BHP, Mount Isa Mines, those sort of Western Mining were the biggest companies, and the banks were very small. For the last 30 years, the banks have been the biggest things in town. We're seeing another turning point. Banks have died. Banks peaked 5 years ago as an engine of growth, re-regulation, Hayne, all the problems we've got in banks. So
their avenues to profit growth has been constrained.
Correct. So the miners are now the generators of wealth and the generators of dividends and profits in Australia, as they have been for most of the last couple of centuries. So that's been good. Share prices have been good. every time we look at the iron ore price, the budget in Australia was set on an iron ore price of $30, $40, $50, $60. It's still around $200. It took a bit of a hit last year with China putting some rules on steel production, but it's still 3 or 4 times as high as anyone thought 5 years ago, which is fantastic for profits and dividends in Australia. Globally, bank dividends are coming back in spades to more than what they were pre-COVID. Retailing. See, one of the things about the world profit growth is that much of the world profit engine, the big companies, Apple's, Google's, Microsoft, etc., are not in any way affected negatively by COVID. They've actually boomed through that. So retailers, travel companies, yes, they've been hit, but the engine of growth in the world is actually largely healthcare is not related to cyclical swings up and downs in economies, nor were they affected by COVID. So globally, if you think about 2019 calendar year, global companies made $2.9 trillion in profit, after-tax profits, reported profits, nearly $3 trillion. 2020, that dropped to, it dropped by $1.1 trillion, dropped by a third to 1.7-ish trillion dollars profit. So that's a massive drop in profits, disappeared last year. Now, the current share prices in every country around the world, and including Australia, are on massive price earnings multiples because they assume profits will grow back. So this time last year, we were saying, look, it's a bit of a rich ask to try and get back to $3 trillion profit this year, 2021. We're already almost there because of commodity prices in Australia, particularly because of bank profits, because of Apple, Amazon, Microsoft, Facebook, all vastly profitable, churning out trillions of dollars of cash. And some of them even paying dividends, which is phenomenal for these outlandish stuff. So, I mean, the Apples and Googles, it's a Google will pay dividend, Amazon will never pay dividend, but the big engines, particularly healthcare, a lot of these companies are very profitable and paying lots of dividends, and buybacks as well will start next year. So, $3 trillion profit in 2019, dropped to $1.7 trillion, and we're all pricing shares rebound on the basis of that $3 trillion coming back. It's almost there. The latest estimates for profit outlooks globally, which is largely US companies ultimately, is now looking at around about $4 trillion for calendar 2022, which is only a year away. We're now into the last few months of 2021. So will profits recover to $3 trillion this year? The answer is probably yes. We'll talk about the virus and lockdowns in a second. Will that, but even if we get to $3 trillion profit by the end of this calendar year, that still leaves you on price earnings ratios of 20-ish, which is still at the full end. Not much fat in there. So more than likely, profits globally will end up at around about 3.5, maybe even closer to $4 trillion in 2022. Again, we look at about 300 companies around the world, and one by one, there are some exceptions of losses out of nowhere for also, Boeing, for example, but most of them, the engines of growth, largely in the US, are heading for the $3 trillion this year, which is the same as it was in 2019, pre-COVID, and another probably 10-15% profit growth on top of that next year. Now, so that every time we look at profit estimates around the world, sort of bottom up, stock by stock, every time we do that, we have to up the estimates because what we thought was, pretty full outlook last time we looked at it last quarter, all of a sudden it's in the bag. And you now look at the next quarter, which is almost all cases pretty positive.
Quite optimistic again. So I think you talk about, I think there's two elements to this. One is how at risk is that outlook or assumption based on what we've seen around the world with the virus, and then part two, obviously, what threats exist to it, both to the actual profit numbers from government changing the position, and also then obviously what that does to valuations too.
That's right. So the first one's the virus, because that's the big unknown. If you look at the daily cases globally, because Australia's got we're all in lockdown, so we see a very small part of it in Australia, but virus cases peaked at the start of this year at about 750,000 new cases per day. They then came off, and then they peaked again in about May this year at about the same, about 800,000. So that second big peak, 800,000 new cases per day. We get about a couple hundred in Australia, but 800,000 new cases per day in around the world. It then fell with all the rollouts, etc., and the lockdowns did work. It fell in about June, July, and we're now on our third. We're now heading up to our third peak. Looking at the numbers, the globally, we're doing around about an average of 600,000. So we had a big peak early in the year, a big peak in June, July, and now we're heading for a third peak in August, September, probably about
as countries open up more as well,
so
particularly around
the
Europe.
new cases. I mean, Europe and US. I mean, you got the experiment in the UK. We're all watching very closely. But the new cases, by and large, are coming from the emerging markets. They're coming from India. They're coming from Indonesia, which is close to home. They're coming from Africa. So we're coming from South America in particular, and they largely stayed away from the first outbreak. So the new cases, the new third peak, which we are still heading up the curve in the third peak, that is looking like another currently 700,000 new cases per day. That's cases. What is different this time is the death rates are lower. So, for example, you look at the death rates, they peaked in early this year at around about 16,000 deaths per day globally, per day. That fell, it repeaked again in May at about 15,000 again. We are now heading up to another peak because, again, with the infections going up and the way it multiplies, the death rates are running, today they're running at around about 10,000 deaths per day. Again, most of them are in India, Indonesia, Brazil, South America. So with much less in the developed world because of vaccines. So the difference is death rates are lower, but we're still running at about 10,000 deaths per day, every day, up or down, and it's still on the third peak upwards. It's
fair to say the markets have almost stopped paying attention to these numbers, and if anything, are looking through it with a fairly optimistic lens.
Well, two reasons. One is, and two very different from last year. One is we know that governments will throw money at anything, and we know that there's a lot of headroom to borrow. Even though governments are horribly in debt at wartime levels, we know that governments, central banks are buying it up dutifully. They're doing their job. They're buying up the government bonds. They're financing their government's debt, as they've been told to do. And we know that the fiscal side, the actual spending side, we know that governments have a lot of headroom to borrow. There's a lot of pension funds in the world, in Korea, Taiwan, Japan, that can't own anything but government bonds. So when a government issues debt, they just have to buy it up. They're not told to. They're not told to buy it. They have to buy it because they have no mandate to do anything else. Most of the pension funds in the world are 70 or 80% government bonds. So there's plenty of headroom to buy these things. So we know that now. I didn't know that last year. We had a massive bond problem in March last year. This time we know there's huge amount of headroom to buy bonds. So governments are just spending money, all of which is good because it creates jobs and incomes. The second difference this year is we've got the vaccines. We've got 5 or 6 vaccines all over the world. Don't tell ScoMo this, but there are vaccines that are available that pretty much everywhere. And that's different. So we know we're in lockdown now, but this time last year, we were sitting down 18 months ago saying, we don't know what the end of it is. We know the end. The end is going to be vaccine rates will go up. I've got double vaccine already. Most of my friends have. 60 whatever percent of the people over 60 are now vaccinated. You've got things going into schools now. So it'll get there. We can debate about how fast or slow, but it'll get there. So we know the outcome is probably a world we live in with the odd infection here or there, the odd sharp lockdown here or there, but pretty much things will be back to normal in a vaccinated world. That's the difference. Like we didn't have that last year. This year we've got that. So
we've got a roadmap for it.
So the death rates are going up, the infection rates are going up, but by and large in the developed world, in our economy, we still rely not on the developed world. We still sell a lot to India and Indonesia and China, but by and large, the vaccines are going to eventually get through to suppress the problem, and we'll learn to deal with it like any other problem, any other risk in the world. So that outlook is no longer as negative and bearish as we had.
That's why the markets are not reacting heavily to these waves that come through.
The markets will react most likely. Now, the other thing is that economically, we had this massive recession last year across the world, deepest, sharpest recession since the 30s. Rebound this year, which is supporting prices. Most of the world is back in double-dip recession. Europe is in double-dip recession. They've had 2 quarters negative in a row, probably a third one coming. Britain's heading for that. US is heading for that. Australia potentially too. So that is not as scary as it normally would be, because we know governments are going to spend money to bail them out, and we know that central banks are going to keep rates at 0 if they have to. They can't cut them anymore, but they'll certainly keep rates at 0 for longer if they have to, and buy bonds for longer if they have to. So they've got a couple of tools here which didn't exist a couple of decades ago. So a recession is not as scary as it was, say, 2 or 3 decades ago. So the outlook is not as gloomy. profits are still rolling in. Every time we look at the profit numbers, we have to tip more money into it because there's just more money there. Now, let's face it, the fiscal spending, the government spending is going straight through to profits. Because every dollar they spend on stimulus goes into someone's pocket, they then spend it, it goes into corporate revenue line, goes into costs, it goes into profits, and it comes out as dividends. So all the spending that governments do, which is good, ends up in shareholders' pockets or staff, employees, taxpayers. So it's all good for the economy. We'll go through double dips. We'll do that. We'll have a couple of double dips. There'll be a Delta strain, and there'll be a 3 or 4 other strains. This time, remember the Spanish flu 100 years ago? The first round killed 10 million, give or take 10 million people, 1919, 18. The second round, a couple of years later, killed 30, 40 million people. Now, that is probably going to be, again, we have virus vaccines now, which we didn't have back then. And CSL, by the way, invented the vaccine back in 1919. That's why it was born. CSL was a government-owned laboratory to develop vaccines for spiders and snake bites, and they developed the Spanish flu virus. A vaccine. We've got 3 or 4 or 5 different viruses. This time next year, we'll have even more viruses, but we'll probably have 2 or 3 more strains, which we don't even know about now. So
variants.
It's a more manageable. It's less of an unknown now than it was last year. Meanwhile, profits are coming in. Governments are spending money. Share prices are drifting up. There'll be the odd wrinkle. There'll be the odd scare. The big worry that will affect markets is going to be, when will cash rates rise?
So when does inflation hit? When does cash rates go up? And then does the music stop?
Yep. So I think, just to recap, I think central banks are terrified of repeating the mistakes of the recent past, i.e. going too early. So they will deliberately go slow. They will, and they've already said, I mean, the Fed's moved from a 2% inflation target to a 2% average target, which Australia's had for years. So every central bank has now said, we will let inflation drift above for a while. What's going to happen is it'll drift above and they'll say, holy crap, I've got to come down fast, and they're going to come down hard. It'll be later than we think, but it'll be harder eventually than we think. And that's the fear of that is going to create the wrinkles in the market from time to time.
So the inflation scares.
Yep.
Yeah. And we've obviously seen, we talk inflation, and obviously very heavily impacts the bond market. And we've seen, as you've talked about there, the sort of the where rates got to in the recovery post COVID up to its September, October peaks, and then gradually wound their way back. And we had another sort of jump around earlier this year.
Yes.
So, what are you seeing for portfolios with regard to bonds, given where we're at with the longer term rates?
So in every portfolio in the mix, every diversified portfolio in the world is basically shares being the growth assets for a property, but primarily shares in companies, listed companies, unlisted companies. And the defensive side of portfolios, whatever your portfolio is, the defensive side traditionally has been stacked with fixed rate bonds, government bonds, corporate bonds, high grade. The problem with bonds is that there's 2 or 3 problems with bonds. One is that the bond yields are being artificially kept so low for so long that the only way to go is up. Australian long-term bond yields are about 10-year bond yields are 115, 120 odd, but they were nearly 1% higher than that now earlier this year. So if I was to buy a bond, first of all, the only way for a bond yield to go is up, and therefore the only way, every bond in the world is priced, the bonds in the world are sold at $100 and they trade at around about $100, give or take. And at the end of the maturity date in 5, 6, 7, 20 years time, you get your $100 back. Every bond in the world, in every market, in every sector of every market in the world is trading above $100, which means if you buy a bond today, you will lose money, guaranteed to lose money, because all you get back is $100. The second problem is that the coupon, the actual interest rate they pay, you and I were growing up, interest rates were 3, 4, 4.5. The average Australian government bond was a 4.75% yielding bond, and it would pay back $100 in 10 years. That bond is now yielding about 1.5% around the world. So you're not getting the interest rate on that to buy veggies every month that you were 10, 15 years ago. And the second problem with bonds, just a bit of technicality here, is most of the bonds in the world are global. So our global bonds are hedged into Australian dollars, and we get a nice little return on the foreign exchange hedge of about 3% per year, free money, because our inflation is higher in Australia. So we don't get a hedge return.
That's gone. Yep.
We don't get any coupon. The interest rate the bonds pay is 1%, not 4 or 5%. And thirdly, the only way for the capital value of a bond to go is down, because you're only going to get $100 back. So in our portfolios for the last 3 or 4 years, we've deliberately been underweight. We're carrying less fixed rate bonds than we ordinarily would do. And what we're going to do, about a third of our defensive holding has been non-fixed rate bonds. It's been floating rate bonds. Now, floating rate bonds go up in value when rates rise. Fixed rate bonds, which is your traditional government bonds, the value goes down when interest rates rise. So we are in the middle now of basically removing most of our fixed rate exposure from portfolios. It's a good time to do it now because bond yields have collapsed and the bond markets have returned about 1% return every month for the last 2 or 3 months, which is good. They sold up a bit in January, February, in March because of the bond yield spike. Bond prices have come back up and bond yields have come down to quite low levels. And unless we have, I think if we have a GFC, i.e. a systemic banking crisis where banks close, like they almost did in the GFC, and if we also have government's inability to spend money, then we would have a situation where bond yields would collapse and we'd have an almighty depression type recession. I don't think it's going to happen because we haven't yet seen a systemic banking crisis like Lehman Brothers almost triggered. And even back then, banks jumped on the bandwagon and bailed out banks. So they'll certainly do it again in half an hour. They'll simply say, let's buy every bank in the world. So I don't see a systemic banking crisis occurring. And secondly, that would require a lack of government response. And I can't see that either. I think governments have been taught post-GFC to bail out everything. And they've got the ability to bail out everything. So I don't see that. That's the only situation I can see where bond yields would collapse to 50 basis points or 0.5%. They're currently around about 1%. So given that that's quite an unlikely scenario, i.e. a Great Depression without governments to help, I don't see that occurring. So therefore, the only way for bond yields to go is up, particularly since spending is creating inflation and jobs growth, which it is around the world. So in that environment, it's a good time now to sell some of the bonds that you've got because they're actually
sell the fixed rate bonds, go to floating and protect the capital.
We were about a third floating rate, which is good when rates rise, and about 2/3 fixed rate. We're going to move in the next few days or over the next week in this cycle. We're going to move to far less fixed rate exposure, so we're less exposed to rising inflation and rising rates in the medium term. I think that's pretty much our scenario is rising interest rates, probably later than we think, but probably more heavy when it does occur. US probably, Australia will follow, Canada, UK, Europe will follow. And therefore, the problem with central banks acting too late and then too hard is the longer they wait, the more the engine of inflation will start to catch on. That if you imagine a train going down a hill, the longer it lasts, the longer it goes down that track, the more brakes you're going to have to stop the thing. And I suspect we're going to be in quite a long way down that hill before central banks finally wake up and say, we've got to raise rates 3, 4, 5 times. Don't forget, in a typical rate rise cycle is about 15 rate hikes. In the last one in 2017 to 18, we got to 9 rate hikes. Now, people get scared thinking about 1 rate hike. We had 9 last time, 3 years ago, and markets sold off. So get used to the idea of 15 to 20 rate hikes to get back to a 3-ish% cash rate. It's a long way away, and that'll scare a lot of people. So it won't happen.
You paint a picture, though, I guess, conflicting forces here of valuations getting maybe not stretched, but certainly a bit skinnier. The train's beginning to pick up a bit of momentum down the hill, but how quickly do you want to jump off while governments are still fueling the engine quite aggressively? What does it mean, I guess, for shares and your allocations to shares?
A couple of things happened. This year was interesting. We've had this monumental speculative boom. I was going to say tech boom, but Apple, Microsoft are tech, and they're not speculative. They actually profitable and pay dividends. So
cryptocurrencies and startups.
Anything. So it's startups, crypto, SPACs, all these sorts of things, IPO boom. anything speculative. So that speculative boom they took a hit in early this year. So early this year, we had a switch between pure speculation for the sake of speculation. And we saw that was probably when Bitcoin hit $60,000 US, that was probably the peak. When Coinbase floated in the middle of April, that was probably the peak of the acceptability of money for nothing, fluff, zero discount rates, creating assets out of nothing. That's turned the corner. So you don't that the tech or the speculative boom, the crazy tulip bubble sort of boom, probably ended early this year, and the Coinbase float was probably if you pick a point, that would probably be it. So a lot of money is still in shares, but a lot of the money's gone out of the speculative side. This is why the sale of Afterpay is genius, because it'll never make any money, and they got it right at the top. They agreed that a couple of months ago, and the deal is now done. So that probably marks the end of that speculative bubble phase. And now there's a lot of money going into cyclical stock, cyclical stocks, retailers, travel companies, engineering, manufacturing, transport. It's slow now, but the money's going into it because they are the cyclical rebound stocks. So we're now no longer in crazy bubble territory, tulip land, which did exist up until about February this year. And probably the bond spike and the scare in February, March said, okay, that speculative phase is gone. It's back into
more rational,
real companies, real profits and real dividends. Now, that still depends on dividends coming back and profits coming back. And so far that's happening, despite the virus, despite the lockdowns, we can see a path out, and the path is more vaccinations, more activity returning, and real profits going back into real companies.
So for now, the advice is stay on the train. It's picking up momentum. It's too early to make your exit.
That train is very heavy, and it's going to go a long way down the hill before the Fed says we'll slam the brakes on. And when they do, it's going to require a lot of rate hikes to kill inflation. They're going to scale out of QE first, and they'll do that probably this year. They'll probably start to talk about a timetable for.
I was going to say that the talk around it is going to rapidly pick up from here. You would expect over the next few months, starting to signal and flag intentions.
The RBA, for example, was buying $5 billion of government bonds every week. They said we'll go back to $4 billion from September. The other day they confirmed that plan, and that's good. The Fed's buying $120 billion every month, and they've educated the market to think about maybe when and how and steps. So it'll happen. I suspect it'll happen probably a bit sooner than we think. So I think, getting back to the original debate, do you turn off fiscal stimulus? Is it Biden spending? The answer is probably no. Do you turn off the monetary stimulus? And the answer is yes, that's got to come down. So start thinking about QE bond buying, which doesn't really affect us directly. Cash rates affect us directly, and we're a long way away from cash rates starting to be high. And there'll be a lot of false starts. They'll raise rates a couple of times, markets will sell off, and they'll say, whoops, they won't come back, but they'll certainly say, well, let's just not do anything for the next 6 months. There'll be a lot of stop-start. Meanwhile, it looks pretty good for profits coming in and dividends coming back, which is what we're after as shareholders.
So at this point, we stay the present course.
Yes, we have, except we're going to take out a lot of the fixed rate exposure and put it into high grade floating rate exposure.
Take the opportunity with the recent decline in the bond yields to allocate more towards floating.
Good time to do that.
Excellent. Illuminating as always, Ashley. Thank you very much.
No
Do you perhaps next month? I get a feeling you'll still be in your library, so perhaps we could get a book report as well.
Well, I can pull out some favourite books. I've got a whole shelf full of Fed monetary policy. Got a whole shelf full of British banking, and a whole shelf full of all sorts of things. Got shelves of Japan, shelves of China. I can pick out a book of the month next time.
Excellent. I look forward to it. Take care.
Brilliant.
Thank you, Ashley.
Thank you all. Good luck.
Thank you, everyone.